Greetings, members one and all of the Salivation Nation. Alert! There's no need to stack gold and silver. The Federal Reserve says it's gonna be okay. Let's explore! Insanity! Yes, indeed, the markets have reacted. There's where the prices are right now. Look at this. Crazy. Look at that. 1830 gold down over 1.5 percentage points, down $30 almost to 1830 and 50. And silver is down 36 cents, down 1.3%. Notice that silver has not been reacting as dramatically as gold has been in terms of its dips. And that's quite telling. Maybe the silver market's coming around. The gold to silver ratio on account of that is just above 67 to 1. So that's positive news for you silver stackers out there. We're starting to get into what is considered the normal area. I think normal for the gold to silver ratio should be anywhere between 55 and 65 to 1. It's still a pretty broad range, but I digress. So there's where the markets are in terms of the prices for gold and silver. Platinum actually took a hit too, but palladium jumped up over 1.74%, almost 1.75 point jump for palladium prices. But let's get to what happened today. Well, the Federal Reserve met, and everything is going to be hunky-dory. That's a little expression you may not have heard in a while. Type that in the comments section below, hunky-dory, to let me know you heard it. And while you're typing that little comment, I encourage you to hit the little thumb up button. Just hit it lightly. We want the button to remain intact so that you can hit it again on the next video. Let's go into this article here. The gold market is losing some ground as the Federal Reserve strikes an optimistic tone on the health of the economy and signals the interest rates could rise by 2023. Before, as you know, they had mentioned that it will be at least to the end of 2023 before they even think about raising rates. And they're now saying there may be two rates before the end of 2023. The U.S. Central Bank said that economic activity and the labor market have strengthened due to strong policy support and progress on vaccines. So there are certain sectors of the economy that are recovering. In fact, it's all around the nation. There's many businesses that are looking for employees. Help wanted signs everywhere. But a lot of people are not going back to work out of either fear or the fact that they'll lose money because they're getting that stymie from the federal government. So the Federal Reserve continues to reiterate its view that rising inflation will be transitory. Transitory, that's right. In other words, it's temporary. It's a big transitory. But I think they like to use that word transitory because it's very close to being trans. It's more of a woke term, it seems like. The sectors most adversely affected by the pandemic remain weak, but have shown improvement. Inflation has risen, largely reflecting transitory factors, the central bank said in its monetary policy statement. They're just going to keep evoking that word, invoking it every time they can to calm our nerves. Everything is going to be okay from the Federal Reserve. Overall, financial conditions remain accommodative, in part reflecting policy measures to support the economy and the flow of credit to U.S. households and businesses. Well, I'll tell you what, that flow of credit is dollars. Those stymies, is that government, those checks that are going out to people, unemployment and otherwise. And it can't last forever, but I tell you what, it is something that's a lot of money that's going to be eventually flowing into the economy again, and that's going to just exacerbate inflation even more. The path of the economy will depend significantly on the virus. Progress in vaccinations will likely continue to reduce the effects on the public health crisis on the economy, but risks to the economic outlook remain. Well, and we can't blame that completely on the virus, although obviously because of the large government expenditures for the various relief packages out there, And that is certainly exacerbating, but we've had trouble before the virus hit, especially with what you guys, Mr. Federal Reserve people, Jerome Powell and others, with the repurchase agreements that we were doing back in December, from September to December of 2019, behind everybody's back. Gold prices have dropped sharply into negative territory, giving up all their session gains. Prices have also pushed below critical initial support at $1,850 an ounce. August gold futures last traded at $1,844.20 an ounce, down 0.66% on the day. However, garnering the most market attention is shifting expectations for interest rates, and I think that's part of what drove these prices down. The projections, also known as the dot plots, show that the central bank is forecasting interest rates to be 0.6% in 2023, which would point to 2 interest rate hikes during the year. In March, the projections call for no rate hikes through 2023. The dot plot is the big early story, said Adam Button, chief currency strategist at forexlive.com. I wonder if he's any relation to Benjamin Button. 7 FOMC members saw no hike in 2023, but 13 now do. What's even more striking is that 7 now see at least 1 hike in 2022, which is as many there were for 2023 just 3 months ago. They've arguably moved the pace of hikes forward by a full year in just 3 months. And they're definitely riding that fine line for sure. And here's a chart that shows those areas here where the GDP March projection moving out. Let's see how that plays out. Certainly interesting indeed. Looking at growth, the Federal Reserve expects U.S. gross domestic product to increase 7% this year compared to the previous forecast of 6.5%. Looking to 2022, the central bank projects that GDP will increase 3.3%, unchanged from March's forecast. Meanwhile, by 2023, GDP growth is expected to increase 2.4%, up from the previous forecast of 2.2%. The U.S. Central Bank is also optimistic that the labor market will continue to recover after the devastation in 2020 due to the COVID-19 pandemic. For 2021, the unemployment rate is expected to fall to 4.5%, unchanged from March's readings. The unemployment is expected to be at 3.8% for next year, down compared from the previous estimate of 3.9%. In 2023, the unemployment rate is expected to fall to 3.5%, which is unchanged from the prior estimate. So the U.S. Central Bank is also forecasting inflation pressures to build. The projections show that Personal Consumption Expenditures Index, PCE, is expected to rise 3.4% in 2021, up from March's projection of 2.4%. Inflation pressures are expected to continue to grow in 2022, with PCE increasing 2.1%, up from the March's estimate of 2.0%. In 2023, the Federal Reserve expects inflation to hit 2.2%, up from the previous forecast of 2.1%. All these different measures, you have the Consumer Price Index as well, but all these government measures have been revised, and they have been revised, whereas the old measures were really have much higher inflation now by the previous measures. I think those are calculated over shadowstats.com, if I'm not mistaken. But it's interesting to see how all these numbers have been revised to make us feel like, hey, we're not in as bad a shape as we are. We really are. Core inflation expectations, which strip out volatile food and energy prices, are expected to rise 3.3% this year, up compared from previous estimate of 2.2%. Next year, core inflation is expected to moderate, increasing 2.1% compared to March's forecast of 2%. In 2023, inflation is expected to rise to 2.1%, unchanged from the previous estimate. Avery Shenfield, senior economist at CIBC, described the Federal Reserve's monetary policy statement as it didn't address any potential reduction in the central bank's bond purchasing program. So there's a lot of smoke and mirrors here. There's no reduction, there's no pulling back, but there's a hint of tapering, at least, it sounds like. The Canadian Bank is also more hawkish on interest rates than the Federal Reserve. Neither a spike in inflation or a second quarter growth rate that is, in our view, could top 9%, could really shake the Fed that much from its dovish stance. Although the latest news from the FOMC gives a subtle nod in that direction. And so when we have these things, and they want to garner the least any bit of good news they can out of these Federal Reserve statements. And so the fact that they're willing to think about raising rates in 2 years is quite telling, and that's affecting gold and silver. It's pure psychology. In other words, what are we looking at for these prices? I believe a buying opportunity. Something I'm not able to do right now, unfortunately, but nonetheless, prices going down. And when I think, and by the way, because of news like this, when the Federal Reserve basically says everything is going to be okay, and the markets react and you see gold and silver drop, to me, that's a good buying opportunity. Now, that's only my view. I'm not a financial advisor, but knowing the fundamentals of what gold and silver are and have been for thousands of years, when we see these dips like this, I think that tells us that we are certainly in a position here where I think that it's going to turn around fairly quickly. The prices will go back up. And why is this? Because I think inflation is not so much in their control like they think it will be. Transitory. They keep on saying transitory. But yet they're predicting higher inflation for the next couple of years here. And more than their targets. But I guess that's their way of saying it's transitory. But even as so, I could see it getting worse. I think once this starts, it's very difficult to kind of tamper it back. And the drastic measures they would be is to guess bond buying back program and basically burning up all that cash and don't recirculate it. But there's a fine line that's going to be drawn there. But in my view, as to the sarcastic nature of my title here, is that this is the perfect time to stack. In fact, I was thinking earlier today, back when gold and silver, especially silver, was so much cheaper, $14, $15 silver is when it was unloved. That's the time to really love silver. And when gold is lower, that's the time to love gold. I wish I really would have loved gold back when it was $300 an ounce. Well undervalued. And how do you determine whether a metal is undervalued or not, or any asset class? Look at the history, look at the price history, and look for, especially for how long it can remain stagnant. Stagnancy, in a sense, provides that buying opportunity, especially if the prices are low, because more than likely they will pop again. And I believe what we're seeing here this past, all of this week with the prices going down provides that opportunity. We are in unprecedented times. There's no question with the increased spending that the government is doing, the national debt deficit spending, and what's happening with inflation. Inflation, I think, is different now than it was in the 70s. But who knows? We could see inflation get somewhat out of control. Dare I say hyperinflation? I think now we're getting to the point at this juncture where, yes, it's hard to get some employees back to keep some of the supply chains going. And that has certainly affected some of the prices. But I believe sooner or later we're going to see enough of these goods and services moving that's going to exacerbate and cause these prices to go up. So in other words, we can't blame, at this point, we cannot, we're getting very close to stop blaming the price increases on increased demand and supply chain issues. Now it's becoming more and more due to inflation. So there you have it. Let me know your thoughts. Are you ready to stop stacking or to sell all your whole stack because the Federal Reserve says it's okay? My guess is that's probably a big fat no from all of us. All right, there you have it. Let me know your thoughts in the comment section below. Would like to extend a multitude of gratitude to you all for taking the time to watch, and encourage you to please rate, share, comment, and subscribe. Greetings, members, one and all of the Salivate